Good evening, students.
Good evening, sir.
Good evening, sir.
Good evening.
Good evening, sir.
Good evening, sir.
Good evening, sir.
Good evening.
I'm sure all of you are well prepared with the subject. Ready for the revision. Most of the things you know, but now we have to do the finer points. Audible?
Yes, sir.
So, as I said, we have to do the finer points, which will help us to get easily more than 80 to 90% in the paper. As far as FM is concerned, we are having 60 marks paper for FM. And it is going to be very simple, nothing to take attention of, very scoring. And I was just going through the questions which were asked in the last paper, December 21 exam. It was so simple that any person who was doing just the basics of FM and going for the exam would have scored more than 50%. But there is a catch here because your FM paper is along with the economics paper, right? So you have to be good in both of them. Try to score as much as possible with this combination. Now, in the exam, your strategy should be that those topics which are simple, which are easily scoring, you have to do first. There is no compulsion that you have to do in the same order in which the question paper has been put. But ensure that you are attempting all the questions and you don't miss the questions. Number the questions properly. So even if you are doing question 2 first, not an issue. So you have to ensure that you are trying to score maximum possible points. That is possible if you are trying to ensure that examiner does not cut even a single mark of yours. It's your hard-earned marks, and do not allow the examiner to cut even 1 mark. So in that case, you have to be as perfect as possible. Whatever workings are required, all the workings should be shown. Wherever formulas are required, write down the formulas because you have marks given by the examiner for the formula. Steps go wrong, you may lose marks for the steps, but ensure that all the steps are there so that marks for the correct steps should be scored over there. These are the small points that you have to keep in mind when you're attempting the book. Okay. And as I said, there may be some topics of your liking which you find easy. There may be some topics which you may not like or which you may be finding a little bit difficult as compared to others. So in the examination, I think by this time all the topics have been done by you, and you should be finding all the topics pretty simple because we have done maximum examples on every topic. Maximum problems have been solved, answers have been explained in detail, and therefore it should not be any problem for you. It should be cakewalk, right? So have the confidence that you can do it. Yes, you will do it. Paper is very simple. Nothing is there, no division is there in the paper. The only thing is that you have to now ensure that whatever knowledge you are having, you are putting that on paper. Now, how is that possible? As I told you, scoring as much as possible. So if you find that topics like working capital or ratios are simple for you, then you can attempt those questions. Bonus questions. For example, last paper I think ratios was asked for 10 marks. So that is like a bonus question. Your eyes should light up when you find a question of 10 marks of ratios, which has got nothing in the paper, which has got nothing in the question, as you just have to, the ratios are given, you just have to fill up a balance sheet. So those types of questions are easy. And when I say easy from the point of view of scoring as well as easy from the point of view of completing your paper on time. So time is a very essential element for your paper to score as much marks as possible. What you have to do is you have to ensure that you're completing the paper on time. If that does not happen, then even if you have the entire knowledge of the paper, that is of no use. So trying to solve questions as soon as possible within the given time, that should be your objective. Okay. So I would say that topics like ratios, topics like working capital, you should be able to finish in 15 to 20 minutes. Yes, 15 to 20 minutes. That that speed should be there by now because you have solved all the possible questions on the topics and you are well thorough with the subject. So that should not be a problem. You should be able to solve every question within 15 to 20 minutes on the topic, until and unless it is quite a lengthy question, which is not possible at the level. Right? So, looking at all these factors, I feel that your FM economics paper will be quite a simple paper, and you should be able to crack it. You should be able to get maximum possible marks. So, let us see. Let us go through what we have got for you. Prepare this nice little revision to cherish. Must have gone through it. The very first topic that we are having, introduction to financial management. The three basic financial decisions that we have done. We always stress about. That is investment decision, financing decision, and dividend decision. All three of which are there. So investment decision, I've told you that there are two types of investments, short-term and long-term. Short-term investment deals with working capital management and its components. That is cash management, accounts receivable management, and the total overall working capital management. Long-term involves purchase of capital assets, purchase of fixed assets, long-term assets. And then we have done capital budgeting, risk analysis to capital budgeting, time value management, that is TVM. Okay. So these three topics are coming under investment decision. So basically, they may ask you a theory question. Theory is a part of paper, so you can't escape theory. So investment decision is the investment in the short term in the form of working capital and long term in the form of long-term capital assets. Financing decision, again, there are two parts to this. What will be the combination of capital or what will be the source of capital that you are going to raise and in what proportion? The sources of finance, the proportion in which you are going to raise the capital, and the cost involved. Cost of capital, that will be the second part of your financing decision. Right? Then we have the dividend decision as to how much dividend is to be paid, what should be the dividend policy, whether it should be per share, whether it should be in the form of percentage, whether it should be in the form of dividend payout ratio. So, what particular dividend policy we should be following for the company? If the cash is not there, then how the dividend should be paid. So, all these things come under dividend decision. Okay. So, financing decisions are basically of three types: investment decision, financing decision, and dividend decision. Objectives of financial management. Objectives, primary objective is wealth maximization, followed by profit maximization. Wealth maximization has to be written first. Profit maximization will be written second. Why? Because the primary objective of financial management is wealth maximization. It is not profit maximization. Profit maximization is a part and parcel of wealth maximization. And we have discussed the reasons for this, where I told you that wealth is a properly defined concept as compared to profit, which is not a properly defined concept. There they ask you a question on wealth maximization versus profit maximization for finance. So you have to know what is the basic difference between the two objectives. Wealth maximization, we say that it is the wealth, the concept of wealth is very good, is very well defined. Whereas the concept of profit is not well defined because you do not know whether it is the gross profit or the net profit that they have to maximize. Whether it is the operating profit or the accounting profit or the cash profit that is to be maximized. Confusion. So wealth maximization is superior as compared to profit maximization. Wealth maximization, wealth is what? It is the present value of all the expected future cash flows. Right? Wealth is the present value of all the future expected cash flows. Profit maximization. Profit is the ultimate figure that we get after taking into consideration the revenue minus all the expenses paid minus the tax paid. So it is one figure which comes at the end of the year. Whereas wealth is something which takes into consideration the risk factor. And in case of profit, the risk factor is not considered now. The time value of money is not considered now. Whereas wealth maximization, we consider the time value of money, right? We consider the risk factor. So all these are the factors and the points that you will write for wealth maximization versus profit maximization. So that is one of the important questions in the first chapter. Then other objectives. Sometimes they ask you what are the objectives of financial management. They don't ask you only primary objective. But we have studied only primary objectives, so we know only primary objective. But other objectives also you should. Other objectives of financial management. Customer satisfaction. The customer wants what? Best quality products. Value for money. Employee welfare. That is also one of the objectives. Improved standard of living. Fair wages payable to workers. So that is also a part and parcel of objective of financial management. Maintaining and improving market share. Yes, because we want to increase the volume of production. We want to reach out to as many markets as possible. We want to expand our business. We want to grow our customers. Good corporate governance in the sense that we should be having a proper policy for payment of taxes. Suppose there is a CSR, corporate responsibility, social responsibility, then that should be done on a regular basis. Okay. So good corporate governance, tax evidence on time, all your GST, your tax liabilities have to be paid on time, other taxes should be paid on time. So that is good corporate governance. Welfare of your employees, as I told you, should be there. So all these are also part and parcel of financial objectives. But as I said, if the question is asking you only for primary objective, you need not write all these things. But if they ask you in general, what are the objectives of financial management? Yes, you have to write primary objective and other objectives. Okay. So in one of the papers, they had asked what are the objectives of financial management. The students, most of the students wrote only the primary objective. So when they ask you objectives, but they have not specified the word primary, it has to be written all the objectives. Okay. Then overview of financial management. What all things are there? Procurement of funds and utilization of funds. What are the two main aspects of financial management? What are the two main aspects of financial management? The question is asked in a different form. So the two main aspects of financial management, when you're asked, then the answer differs. Though the points are the same, but we present the answer in a different form. See, in the first case also, financing decision, I said investment, financing, and dividend. There the question asked will be financing decisions, the three arms of financial decision. The financing decision, here we are asking financial management. Okay, the three arms of financial management. The three arms of financial management, or other two arms of financial management. One is procurement of funds, and the other is utilization of funds. The same answer we are putting it in a different format because question format has changed. Right? So they are asking us as what is the overview or what are the main purposes of studying financial management. Right? So now I'm writing procurement of funds and utilization of funds. Procurement of funds, how do we raise the funds? What are the different sources? So then I will say that it depends upon what type of investment decision I'm making. If I'm making a long-term investment decision, I will require long-term funds, which will come in the form of owners' funds and borrowed funds. Owners' funds, share capital, preference share, equity share, resources of this. Borrowed funds, your loan capital. Okay, debentures are taken, bonds are issued, debentures are issued, loans are taken, long-term loans. So that will be a part of borrowed funds. If it is for working capital purpose, then I have trade credit coming from creditors, short-term loans, okay, cash credits coming from banks. Bank overdraft can be one of the terms that we can use with. Okay. Then utilization of funds. Utilization of funds maybe for long-term purpose, where I'm making investment in long-term projects, long-term fixed assets, or it may be in the form of investment. I'm investing in the working capital of the business. Right? So, overview of financial management, answer is different. Your financial management decisions, financial decisions, yeah, answer is different, but points are the same. There also we discuss the same points, there also we discuss the same points. But presentation should be in a different way because the question asked is different, right? That is your first part, that is introduction to financial. But here sometimes they also ask you the questions on the primary functions of a financial manager, or what is the role of a finance manager, how the role of the finance manager has changed in the present day scenario. So all these questions are covered in the theory part of your FM material. You can just check your FM material. At the end, I have given you a lot of theory questions. So there you can just check. You will find that these questions are covered. Primary functions of treasurer. Treasurer is a part of finance. So primary functions of treasurer, what is the role of finance manager in the present scenario? So all those questions have been covered in the theory section of your capstone. Please refer to that. Theory questions are a part and parcel of your examination. So you never know when you can rely on the theory questions. Sometimes they can be a risky. Okay, certain things that we are having here. What is working capital management? Classification of working capital, the concepts of working capital. So let us just briefly go through the concepts. So working capital, we can have the accounting concept and we can have the financial concept. Or basically, I can say that we can have working capital divided into two parts on the basis of concept and on the basis of time. I can classify working capital. On the basis of concept, I can say gross working capital, net working capital, negative working capital. Okay, gross working capital is the finance concept. Net working capital is the accounting concept. Negative working capital is also accounting concept. Okay. Now, gross working capital, why it is a finance concept? Because in finance, when we talk about working capital, it is different from what we are talking as working capital in accounts. From the very definition, it becomes very clear sometimes. Because in accountancy, when I talk about working capital, the first thing that comes up, it is the excess of current assets over current liabilities. Why? Because you know the equation, current asset minus current liabilities equal to working capital. So my definition also comes out like that, okay, that it is the excess of current assets over current liabilities. True. But that is the net working capital, it is the accounting concept. Right? Then we say sometimes working capital is the amount of current assets required to finance the current liability. That is accounting concept. Where we say that your current assets are required to finance your current liabilities. Whereas in financial concept, we look at it the other way. You know what we say? We say that working capital means the amount locked in current assets or invested in current assets. So as I always maintain that for an accounting person, assets will be better. Assets are good, liabilities are not. But for a financial person, assets are not good, liabilities are good. Reason? Because liabilities are the source of finance. I look at it from that point of view. I'm looking at it as a financial matter. It is a source of raising capital. It is a source of finance. Right? And assets for a financial manager are where you have blocked your funds. You purchase a building, you have blocked your funds in the building. You have purchased machinery, you have blocked your funds in machinery. You have purchased furniture, you have blocked your funds in furniture. You have manufactured goods, you have blocked your funds in inventory. You have sold goods on credit basis, you have blocked your funds in accounts receivable. Right? So the way of looking at it differs when you're talking about working capital from the accounting point of view and from the financial point of view. So from the accounting point of view, I say it is current asset minus current liability. Okay. So net working capital from the accounting point of view is always your current asset minus current liability. Whereas in the form of financial concept, it is only current assets, total current assets, gross working. So from the financial point of view, I say working capital is total current assets, the funds which are blocked in current assets. Okay. Negative working capital, again an accounting concept. It's also accounting concept. Because we are making use of the equation, current asset minus current liability. So where your current liabilities are more than the current assets. Current liabilities are more than the current assets. You get a negative working capital. What does negative working capital indicate? Negative working capital indicates deficit of working capital or shortage of working capital. So negative working capital represents deficit or shortage of working capital. And how will you meet this shortage of working capital? You will meet this shortage of working capital from short-term funds. Short-term funds like your trade credit, which is coming from creditors, your short-term loans, which are possible, bank overdraft. All these are sources of short-term funds, cash credits. So that deficit or shortage, you have to meet out of short-term loans. Okay. The working capital classification based on time basis. Can classify as permanent working capital and temporary working capital. Permanent working capital, it is fixed working capital. Another name for permanent working capital is fixed working capital. And temporary working capital is fluctuating working capital. Okay. Fixed working capital, fluctuating working capital. The basic amount of capital, working capital, the basic amount of working capital that is required for running your day-to-day business. Minimum amount, you can say, that is required for running your day-to-day business. That is called as permanent working capital. Whereas, over and above that basic working capital, the minimum working capital that you require is called as temporary working capital. So, if you are having working capital, let us say that I'm giving you these are already discussed in the book of yours. So, suppose I give you March, April, and May working capital as let us say 50,000 here, 25,000 here, 40,000. Okay. Out of these three, the minimum amount is your permanent working capital. The permanent working capital is the minimum, that is 25,000. So this 30,000 I can break up as 25 plus 5. This is 25,000. This is 25 plus 15. Okay. So what has happened is that I have classified the total working capital required into two parts. A fixed component, that is 25,000. What is this? This is minimum amount required at any point of time. Over and above that, if you require anything, that is a fluctuating capital. This is a temporary working capital. So here you require only 5,000. It is temporary working capital. Here you require 15,000. Temporary working capital. It is required only for 1 month. Okay. So over and above the fixed working capital or the basic working capital, the minimum working capital, that is your fluctuating or temporary working capital. Okay. So all these things, wherever possible, I have given you reference of the CAPS material where you can refer to that. So if you are studying with your CAPS material and your RTC, your revision to cherish that sheet that is given in the PDF format. That particular thing, when you sit with your material, CAPS material, you can refer to that. Okay, so all these things are covered in your CAPS material. Page 12. Operating or working capital cycle. Operating or working capital cycle is very simple. It is the time period that is required for converting raw materials purchased back into cash. So the operating working capital starts from the day you purchase raw materials on credit basis, and creditors come into existence. From that day, your working capital cycle starts. So you have inventory of raw materials. This inventory of raw materials, you are not going to use all the inventory at one time. It will be used in small quantities. Let us say you have purchased 50,000 units of raw material, right? So every time you are going to use only 10,000 units of raw material or 5,000 units of raw material. So maybe over a period of 1 month, that raw material stock gets over. So you are having a holding period of raw materials. That holding period will be blocking your price. Okay. So that time period for holding of raw materials. Then once the raw materials enter the production process, it will be in production process for maybe 1 month, 2 months, 1.5 months. That is called processing time. So processing period, raw material holding period plus processing period. What is happening now? I'm incurring expenses. Raw material storage, I'm incurring expenses, outflow of cash. Is there any inflow? No. I'm manufacturing goods. I've introduced the raw material into the production process. Is there any inflow of cash? No. I have to pay cash. I have to pay wages. I have to pay overheads. So outflow of cash is there, right? When these goods are ready, they become finished goods. Again, they come back to the godown. They have to be stored to storage cost. Again, outflow of cash, no inflow of cash. Goods are sold to customers. Debtors come to existence. Is there any inflow? No. Debtors are come to existence. Accounts receivable. They will pay after 3 months. So again, my funds are blocked for 3 months. So debtors holding period 3 months. Collection period is 3 months. Right? So raw material holding period, work in progress processing time, accounts receivable correction period, finished goods holding period, all that is blocking. So there is no inflow of cash. There is only outflow of cash during this period. After this, what happens? Accounts receivable are converted into cash. And from that cash, I make payment to creditors. So that entire time cycle that is there, right from purchase of raw material to its conversion into cash and payment to creditors, that is called as one operating cycle or one working capital cycle. So for large manufacturing concerns, your working capital cycle is a longer period, a longer duration. For small organizations, the working capital cycle is normally small. Shorter the duration, the better it is, because you have more liquidity, you have more cash, right? So that is your operating or working capital cycle. So R plus W, that is raw material holding period plus work in progress processing time plus finished goods holding period, debtors collection period, creditors payment. Now for this, I have given formulas also. I think given in the CAPS material, the formulas are given there. Raw material holding period, average stock of raw materials, wherever possible, wherever possible. If the opening balance and closing balance is available, take the average stock of raw materials, opening plus closing divided by raw material consumed, never raw material purchased. If they have given the raw material consumed, then always go for raw material consumed, not for raw material purchased, because you are holding a stock of raw materials. Depends upon how much you are going to consume. Okay? It does not depend upon how much you are going to purchase. How much stock you are going to hold, it depends upon how much stock is required for production, how much you are going to consume. So that is why it is average stock of raw material upon raw material consumed. Now, in some problems, raw material consumed may be equal to raw material purchase. Some problems, raw material consumed may be equal to raw material purchase. When does that happen? Let us see. What is the formula for raw material consumed? Raw material consumed formula is opening stock of raw materials plus purchase of raw materials minus closing stock of raw materials. Now, if opening stock and closing stock are equal, if the assumption is that opening stock, I may be given the closing stock because I will get this on the balance, closing balance, but opening stock may not be given. So what do I assume? I assume that opening stock is equal to closing stock. When that happens, so suppose I'm having 5,000 here, I'm having 5,000 here. What will happen? 5,000 plus and 5,000 minus will cancel. Therefore, your raw material consumed is equal to raw material purchase. Okay, I'll come back to this when I'm doing working capital, the main problems. So, raw material consumption is normally this, but when opening stock figure is not available, my assumption is that opening stock and closing stock are equal. Not that assumption is that opening stock is equal. Opening stock and closing stock are equal. Therefore, raw material consumed is equal to raw material purchase. In that case, raw material consumed or purchase. If raw material consumed is not given, I will make the assumption that raw material consumed is equal to raw material purchase because opening stock is equal to closing stock. Okay. Then work in progress, processing time, average stock of WIP, again average stock. Always, wherever possible, it is average stock. So average stock of WIP upon average cost of production. Okay. Into either number of days 365 or number of months 12 or number of weeks, depending upon what data is given. If data is given in weeks, go with the 52 weeks. Data is given in days, go with 365 days. Right? Finished goods holding period. Finished goods holding period, average stock of finished goods. Again, I'm talking about average stock. Average stock of finished goods. Opening stock plus closing stock divided upon average cost of goods sold. Debtors collection period, average accounts receivable upon net credit sales, Remember this, it is credit sales. Sometimes it will include total sales. Total sales will include cash sales. Minus the cash sales, get the credit sales. Then again, it is net credit sale. If there are sales written minus certain. So total sales minus the cash sales minus the sales returns and allowances will give you net credit sales into 365 Then creditors payment period accounts payable, average accounts payable. Again, average accounts payable. Everywhere it is average. Wherever possible, take the average. Upon net credit purchase again. So total purchase minus the cash purchase minus the discounts of any net credit purchase. Multiplied by 365 Okay. So this will give you, when you're calculating this, all will be coming in number of days or number of months or number of weeks as you have calculated. Now, what you will do is this particular period plus this particular period plus finished goods holding period plus debtors collection period, total of this and minus whatever you get. This will be the operating. Okay. Here, now coming to working capital policies. Different types of working capital policies. Again, this has been given in the caps material, page 14 and 15. You have got aggressive policy, conservative policy, moderate policy. On this basis, we are having question also asked in the exam, which has been put in my study material. Your caps material. Aggressive policy, conservative policy, and moderate policy. Basically, when we are talking about the working capital policies, how much of working capital is to be held? How much of working capital do we require? So if I maintain a large amount of working capital, what is if I maintain large amount of working capital? It means that I'm maintaining large amount of current assets. If I maintain large amount of current assets, that means funds are, look at it again from the financial model. Funds are blocked in working capital. Funds are blocked in current assets. Large amount of working capital means large amount is blocked in current assets. If large amounts are blocked in current assets, I could have utilized that amount to invest outside the business and I could have got some returns. Correct? Now, because large amount of funds are blocked in current assets, I cannot get those returns. I could have invested it in, I could have put it in a fixed deposit, got the interest from that. But now I can't get that because my funds are blocked in current assets. So if a large amount of funds are blocked in current asset, your returns on capital, your returns on investment is less. If returns on investment is less, your profit is less. And when do you maintain large amount of working capital? Because you want to be conservative. You want to be protective about your company. You want to be conservative about your company. So you maintain large amount of working capital. So that is a conservative policy. Okay. So in conservative policy, large working capital is there. Large amount of working capital. In aggressive policy, we have less amount of working capital. Okay. So where the investments are large, I'm trying to be protective. I'm trying to be conservative. It is a conservative policy. Where working capital is less, I'm taking a chance. I'm taking a risk. Okay. So this point of view, again, large working capital, conservative policy, low risk. Low risk. Aggressive policy, what will happen? Aggressive policy, less amount of working capital. So risk is high. High risk. Risk is high. Why the risk is high? Less amount of working capital. In case my liabilities become due for a payment, I may not have sufficient current assets. Or I may have a large amount of current assets in the form of stock, inventory, or accounts receivable, which cannot be easily converted into cash. So in that case, I will be stuck. I will not be able to pay my liabilities. Right? So this can be your way of arguing aggressive policy and your conservative policy. Other factors which are there. Long-term funds used for aggressive policy. Long-term funds used in fixed assets and partly in permanent working capital. Conservative policy, fixed assets, permanent working capital, and partly in temporary working capital. Distinction answer. Comparison, not distinction, comparison. Short-term funds used entirely in temporary working capital and balance in part of permanent working capital. Conservative policy in permanent working capital to the extent the long-term funds fall short. Liquidity is low for aggressive policy because less amount of working capital is there. The liquidity is low, cash is low, cash is large amount of working capital, we are having large amount of liquidity is high. Profitability, high returns on assets but considered risky. High returns, why? Because I'm investing maximum amount outside the business. I'm not investing in working capital. I'm investing outside of the business. So returns from that is coming very high. But there is a risk, very risky, because as I told you, less amount of working capital. Suddenly a liability comes up for payment. I may not have sufficient funds. So there is a risk for default. Low returns on assets, but less risk. Okay. So that is your working capital policy. Thanks. Moderate is something in between aggressive policy and conservative policy. Risk return trade-off. Again, this part I have explained in the caps material, page 16. What I have written over there. This question has been asked in the past exams, and therefore students are requested to study it properly before the exam. So, what is a risk return trade-off? Very simple. First of all, trade-off means exchange. Okay? Trade-off means exchange. Now, suppose I'm writing risk over here and the returns over here. Okay. If I ask you how much of risk you want to undertake, you want to undertake a high risk or low risk, you will say, sir, I want to take low risk. But then I will say, okay, then you are satisfied with low returns. You say, no, sir, I want high returns. Now, this is a mismatch. Because for high returns, you require high risk to be undertaken. And for low risk, you will get only low returns. But you want the opposite. You want high returns also, and you want less amount of risk also. You want to become a chartered accountant also, but you don't want to study also. Correct? You want the paper to be easy, and everything should be the MCQ form, and you just want to put in the tick marks. That is your dream. But that does not happen. That does not happen. So that is the case, and all the students will become chartered accountants in overnight. Like you study for BCom exam, you get up in the morning of the exam, you study and you get 50 plus. The same thing would happen for CA exam. So returns you want high. You want to become a chartered accountant, but you don't want to undertake a risk. That is not possible. So if you are entering a CA exam or a professional course, what you have to do? You have to be willing to undertake more amount of risk. So you should compensate. You should undertake more risk and sacrifice a little amount of return. Sacrifice your enjoyment a little bit. So maybe 10%, 15% sacrifice of your enjoyment because you want to prepare for a professional exam. So you don't want to enjoy full life. If you enjoy full life, then examiner says, go enjoy. I will give you second attempt, third attempt, fourth attempt. Come back as soon as possible. Every time you come back, I will be happy. Because I get per paper, I get X amount of money for correction of papers. So more students coming back more and more time again, I will get more available. Okay. So examiner is not worried about your passing in first attempt or passing in second. He is worried about his level. But you are concerned with your career. You want to become a chartered accountant. So you should be willing to sacrifice a little bit of your enjoyment, what you normally do, and take a little bit higher amount of risk. So that means what you can see here, you are increasing your risk and you are reducing your returns. You say, I'm satisfied with less returns, but I will undertake this. I will sacrifice a little bit of my enjoyment, but because after 3 years, I will enjoy the entire life. After I become a chartered accountant, signature power is there. I will enjoy my entire life. So for 3 years, I will sacrifice it. So I don't mind having little bit less of enjoyment, but I will undertake a little bit more risk to try to complete my CAs. So that is where you are sacrificing a little bit of risk, returns, and undertaking a little bit more risk. What is that? That is give and take. That is give and take. That is a trade-off. Okay. So companies want a trade-off like this to happen, so that there is a balance. There is a balance between returns and risk. That balance is called as risk return. Any difficulty? Are you clear with the concept? Many times it has been asked in the examination. So see that your clarity of concept is that you should be able to write something else. Then once you get your working capital, you will be asked sometimes in certain questions. Of late, they are asking you this maximum permissible banking NPBF. And there are three methods. Three methods. First method, you have to study the same order. Order cannot change because depending upon the method, the formula comes. If it is method one, NPBF is equal to 75% of working capital. 75% of working capital because CA minus CA is working capital. This part is working capital. It is 75% of working capital. Second method is 75% of current asset. You can see that I put a bracket for it. 75% of current asset minus entire current assets. Third is 75% of current asset minus CCA. What is CCA? Core current assets. What is core current asset? Minimum amount of current assets which are required to be maintained. Minimum amount of raw materials, minimum amount of finished goods, minimum amount of cash in hand, minimum amount of bank balance that is required to be maintained. That is your core current asset. So total current assets minus the core current asset, 75% of that net balance minus 100% current assets. Okay. What is maximum permissible banking finance? Maximum permissible banking finance is where the company wants loan to finance a working capital, but banks are reluctant to do. Banks are reluctant to do. Why? Because when they calculate your current ratio, they find that it is not favorable. Short-term solvency ratio, liquidity ratio, that is not favorable. So they are reluctant to finance you for working capital. So what is the minimum amount that the bank is willing to provide you as loan for a finance working capital? That is your maximum permissible banking finance. Now, what is the beauty of this? The beauty of this is that in method one, what happens? The amount which is available, working capital, is maximum bid. And in method 3, it is minimum. You can see from the formula. In the first case, I'm taking 75% of total working capital. Okay. So the maximum amount of working capital, if you can't provide this, at least provide the second one. That is also not possible. At least the third one. So maximum amount of working capital is in the method 1. Minimum amount of working capital, financial assistance, is in method 3. But profit for bank, in the form of returns. Will be if method 1 is correct. Because method 1, maximum amount of working capital loan is good. Okay. So in that case, your interest will be high. If you are providing minimum amount of working capital, the interest will be low. So here the bank profit is low. Here the bank profit is high. But here the risk, let us talk about risk. The risk is less only, and it is high. Concept is clear. If you are providing minimum working capital as loan, then minimum loan as working capital. That means your loan amount is minimum, so your returns will be minimum. If your returns are minimum, what is the relationship of return and risk? Direct relationship. If your returns are less, your risk is also less. But if you undertake more, if you give more amount of loan, you get more amount of interest. Returns are high, but risk is also high. Alright. So this particular part you have to understand, because sometimes they may ask you to calculate current ratios under all the 3 methods. Current ratios under all the 3 methods. Okay. So watch out for this type of question. Now, working capital question normally is simple question, but there are small points which you have to keep in mind when you're solving the problem. For example, I've mentioned a list of items. If you take into consideration these particular points, solving the problem, there will be no possibility of error. First, working capital from finance point of view refers to gross working capital, that is total current assets, not the net worth. Okay, so working capital from the finance point of view refers to gross working capital and not the net working capital. Second, net working capital is an accounting concept. It refers to total current assets as reduced by current assets. So it is current asset minus current asset. This is only total current assets. Most important point for working capital. If annual figures are not given, annual raw material purchase or consumed, annual wages, annual production volumes, if they are not given, they have given you per unit figures, then you have to prepare a revenue statement to get the annual figures. Because working capital, when you're asked in the exam, if they have given you material cost is 10 rupees per unit, wages are 15 rupees per unit, you are given the per unit cost. Then always find out the annual cost. Annual cost you find out by multiplying by number of units and getting the revenue statement. So first prepare revenue statement. Students, you are going to have marks for the revenue statement preparation. Don't avoid the revenue statement in the working capital problem if annual figures are not given. Okay. Next point is that in the working capital statement, various items are valued differently. So working capital, you start first with what? You start with your stock. Okay. So let us say you start with stock. So you will be starting with stock of raw materials, stock of work in progress, stock of finished goods. Each one is valued different. Then you have accounts receivable, that is sundry debtors. Then you have bills receivable, if any. Then you will go for prepaid expenses, if any. Correct? Then you will go for cash in hand and cash in mind. Then total current assets minus current liabilities made up of sundry creditors. Again, valuation is different. Okay. So every item in the working capital statement has got a different basis of valuation. So I have given you each and every one specifically. Stock of raw materials are based on raw material consumed. This has been explained to you from the beginning. It is based on raw material consumed and not on the basis of raw material purchase. Okay. Stock of raw materials is based on consumption and not on basis of purchase. Work in progress is valued at 100% cost of raw materials and 50% cost of wages and goods. What is the assumption for this? I'll tell you. The assumption for this is that raw materials are fed into the process at the beginning of the process. At the beginning of the process. If the raw materials are fed into the process evenly throughout the year, then I will take raw material also at 50%. So read the question properly. Sometimes they tell you that raw materials, wages, and overheads accrue evenly during the year. What is the meaning of that? It means that raw materials are also at 50%. But if they say that wages and overheads accrue evenly during the year, raw material they are silent. It implies that raw material is introduced at the beginning. Whatever raw materials are required, introduced at the beginning. So 100% cost of raw and 50% cost of wages and goods. Okay. Third part, finished goods are valued on the basis of cost of production. And my dear students, don't mix up costing and FM. Costing, whatever cost of production is there, that formula is different. Whatever formula is there for FM, for cost of production, that is equivalent to your factory cost of works cost and costing. Cost of production in FM, this is FM cost of production, is equal to your factory cost as per costing. Please understand the difference. Right? Cost of production in your cost sheet is your prime cost plus your works cost plus your office overheads. But here we don't take office overheads, we don't take administrative overheads. it stops at works cost. My cost of production stops at works cost in finance for the topic of working capital. Okay. So I've given over there. Cost of production includes what? Direct materials, direct wages, direct expense, factory overheads only. It will normally not include administrative or selling costs. Normally not include. So I've not said that it is not going to be. I say that normally it is not. 99% it is not. 1% chances. When they have said that valued at office cost of production, when this word is used. What is valued at office cost of production? Inventory. Word is missing. Alternatively, inventory may be valued. Okay. At office cost of production. So when they use this word office cost of production, it includes administration costs. Otherwise, okay. If finished goods are to be calculated for more than one, it is assumed that goods are valued on first in first out basis. So whatever is purchased first will be good. Okay. However, in certain problems, it may be mentioned in the problem as average basis. Then make use of weighted average. Otherwise, the normal assumption is first in first out. Okay. Then, unless mentioned in the problem, sundry debtors will be always valued at selling price. Unless there is a cash cost method. If there is a cash cost method, debtors also will be taken at cost. Nothing is done, problem is silent. I will take debtors at selling price. What is the reason? Can you tell me why it is taken at selling price? Any idea? Yes, Ashwini, can you tell me? Why do we take debtors at selling price? Debtors are taken at selling price because we are doing topic of working capital. Working capital means what? How much of funds are blocked? How much of funds are blocked? So how much of my funds are blocked? The amount that is receivable from my customer is blocked. And what is the amount receivable from my customer? Selling price of the finished goods. Selling price includes profit. Correct? So my profit is also blocked. That is why I take it at selling price. So why debtors at selling price under normal conditions? So nothing is going because the funds which are blocked, are including my profit. That means the funds which are blocked at the selling price of the finished goods receivable from the customer. That is good. Okay. Next one. Cash balance, if given in the problem, will be taken along with current assets. If given as a percentage, then preferably take it at the end of the working capital statement. So if they say that minimum cash balance required to be maintained is 5,000, take it along with the current assets. All the current assets, you are stock in the stock of raw materials, finished goods, working capital, everything. And then what you will do is, at the end of the current assets, cash in hand 5,000. But suppose they say that cash in hand is 5% of working capital, or cash in hand is 5% of current assets. Then take the cash in hand after you take your current assets. So take current assets, total, minus on that current assets, balance, and then you add a cash balance, 5% of total current assets. So if given as a percentage, take it towards the end of the problem. Point is clear. Okay. Next one. Important. Next one is important. Creditors will always be taken on the basis of raw material purchased, not on the basis of raw material consumed. Because creditors come into existence because we have purchased raw materials on credit basis. creditors come into existence because we have purchased raw material on credit basis. So purchases. Whereas when we did stock of raw materials, what did we say? Stock of raw materials, we said that it is always on the basis of raw material consumed. Okay, raw material consumed. This was it. But when we are talking about creditors, we say what? It is on the basis of raw material purchased. However, sometimes raw material purchase is not given. If raw material purchase is not given, then purchase is equal to raw material consumed plus closing stock minus opening stock. When all details are given, purchase is equal to raw material consumed plus closing stock when it is a new company or a new project, because there will be no opening stock for a new company or a new project. Fair enough. Opening stock will be there with that. You are starting a new company, or it is the first year of your production. We give it to you in the problem. So, starting of the problem, you have to read the problem. Company has just started a business. Then it means that opening stock is going to be there. Then it will be this particular formula. Purchase of raw material is equal to raw material consumed plus closing stock. Okay. And where opening stock is not given, then purchases are equal to raw material consumed. So this part is equal. Purchase is equal to raw material consumed. That is when details of the opening stock and closing stock, opening stock are not available. So we assume that opening and closing stock are equal. Fine. 10th point, check whether expenses are outstanding or prepaid. If they are outstanding, it has to be a part of current liability. If it is prepaid, it will be a part of current assets. Last one, most important point, I've highlighted that. If working capital is calculated on cash cost basis, then non-cash items are to be excluded. What is the non-cash item? Depreciation, amortization. Non-cash item, depreciation, amortization. Writing off of bad debts. Okay, so all those non-cash items are to be excluded from the calculation of cost of WIP, cost of finished goods, and sundry debtors. Also, exclude net profit before tax from sundry debtors, because we don't want profit element, we want cost basis. So there are two adjectives here. What are the two adjectives? One is that it is a cash item, that is non-cash items to be excluded. Non-cash items are depreciation and amortization. The other word that is used here is cost basis. What is the cost? Cost basis is what? It will exclude the profit from the sundry debtors calculation. Which profit? Profit before tax, not the profit after tax. Profit before tax has to be excluded. Okay. So these 11 points are known by you. Working capital is okay. Okay. So they are not something special. It is part and parcel of project. You must have done that when you are solving the points. But now I'm just highlighting those points here. Okay. 12th point. In case of working capital for double shift, word uses double shift. All variable expenses will double. Fixed expenses may remain the same, or maybe that there is a corresponding increase. However, the processing time of WIP will decrease, not increase. Students always remember double shift. That means when you are working more, your processing time will reduce. Why? Because what you are doing in 30 days in single shift, if you are following a double shift, you will be able to do it in 15 days. Am I right? If you are doing single shift, whatever work you are doing in single shift for 30 days, if you follow a double shift, what will happen? It will take half the time, because you are doing double the work in a day. So it will take half the time. The processing time comes down, it reduces to half. Okay. So WIP will decrease. This is on assumption that the two shifts are interdependent. Okay. Now, example I'm going to Working capital. So, CAT Limited wishes to commence its operations on 1st April 2020, proposes to produce 36,000 completed units. 36,000 completed units. During the year 2021, for which the following information is given: raw material cost, wages, variable overheads, fixed overheads, including depreciation, is given to of 0.5. That means excluding depreciation, it is 2.5. Profit is given as 6, selling price is 25. Stock of raw materials, 1 month's average consumption. Consider raw material stock as basis of consumption. WIP, 1 month's completed units. Materials fully supplied. That means 100% materials, 100% materials. And 50% of wages and work. Stock of finished goods, 1 month's completed units. Credit period allowed to customers, 2 months. So stock of finished goods on the list of completed goods. 1 month's completed goods. Credit period allowed to customers, 2 months. Credit period allowed by suppliers, 3 months. Timeline and payment of wages and overheads. Outstanding wages, outstanding overheads, 1 month. Cash sales, 20%. Cash purchases are 20%. Now, this is important for calculating your debtors and creditors. If you don't read the statement or you forget the statement in the calculation, you will be calculating the total sales and total purchases, which is incorrect. You have to calculate credit sales and credit purchases. Minimum cash balance required is 21,000 and safety margin is 25%. Prepare statement showing working capital on cash cost basis. Whenever it comes to the problem, highlight. So remember that in the calculation of WIP, finished goods and debtors, exclude depreciation. Exclude depreciation. Okay. Now solution we have taken. Okay. Raw material cost 8 into 36,000. I got 2,88,000. Then wages are taken 4 rupees into 36,000, 1,44,000. Variable overheads are 4 rupees into 36,000, again 1,44,000. Fixed overheads excluding depreciation. So I told you 2.5. So 2.5 into 36,000, that gives you 90,000. And depreciation for the purpose of calculation, I have taken 0.5 because depreciation is 0.5 into 36,000, that is 18,000. The same working I do for 3,000 also. So completed units plus the work in progress gives me the annual figures. As I told you, first calculate annual figures. First calculate annual figures. So in the problem they have given you per unit figures. Okay, this is per unit cost structure. So as I told you, first calculate the annual figures and preferably prepare revenue statement. Preferably prepare revenue statement. So after I calculate the annual figures, 6,84,000 is the cost of completed goods, finished goods. 3,000 is the work in progress. Annual figures are given to 7,24,500. Now, revenue statement when you prepare, how many units you have sold? 36,000 are completed, but have you sold all 36,000? Answer is no. Okay. So proposes to produce 36,000 completed units. The cost structure is given to you for 36,000 completed units. Right? But how much have you actually sold? 36,000 minus 3,000. Okay, you have actually sold. So 8,25,000. 25 into 33,000. That is 8,25,000. Okay. Material cost again at the same per unit cost that you have taken. Wages, variable overheads, all calculated for 33,000. 36,000 units. Sorry. All this cost of goods sold is for 36,000 units. Okay. 36 plus 39,000. But this we are going to take these figures. 3,12,000, wages 1,50,000, variable overheads 1,50,000. These are the annual figures. So all the annual figures are taken. Okay. Depreciation is taken 18,750. So 18,000 for the completed goods, 750 for the WIP. Total 18,750 is considered. The revenue statement, everything will come. Depreciation, amortization, everything will come. Where I am not going to take the depreciation in the working capital statement. I'm not going to exclude them from the revenue statement. I'm going to exclude them from the calculation of working capital. So in the revenue statement, everything will 7,24,500 minus from add to that opening WIP which is nil, closing WIP 40,500 from the working that we have got here 40,500. Okay. Already calculated. 6,84,000. Add opening stock of finished goods nil less closing stock of finished goods 57. Net amount is 6,27,000 divided by number of units sold. I'll get 90. Profit is 1,90,000. Now once I prepare this revenue statement, as I told you, the revenue statement will carry marks. So if the problem is for 10 marks, you can be sure that at least 4 marks are profits. Okay. So current assets. Annual figure of raw materials. Holding period is 1 month. So 3,12,000 into 1 by 12. Work in progress 40,500 minus 750. Why? Because 40,750 is your total, including depreciation. I have to minus this figure. Cash cost basis, 3 items you have to minus the depreciation. WIP calculation, finished goods calculation, debtors calculation. Okay. So in the calculation of WIP, I minus the amount of depreciation. So 39,750. Finished goods 6,84,000 minus 18,000. 18,000 is what? 18,000 is again depreciation. So 6,84,000 is the total cost. Total cost. From this, I minus the non-cash item depreciation of 18,000. So I take 6,84,000 minus 18, 1 month's holding period into 1 by 12, I'll get 55,500. Sundry debtors at cash cost. Total sales 8,25,000 minus. Let us come back to the revenue statement. 8,25,000 total sales. Okay. Minus from that profit. What is your profit? 1,98,000. Okay. Profit before tax. So 8,25,000 minus profit of 1,98,000 minus 16,500. What is 16,500? It is your depreciation. It is your depreciation. 16,500 on what? It is on the debtors. So how do you calculate 16,500? It is a proportionate amount of depreciation. Depreciation 18,000 is on the total cost of goods which are produced and sold. But we are not selling all. We are selling only 33,000 goods. Okay. How do you get the 16,500? 18,000 total depreciation multiplied by 33,000 units which are sold because we are calculating debtors. Units sold 33,000 divided by total number of units produced 36,000 completed units. Okay. So 18,000 is your total depreciation. Proportionate amount for 33,000 units sold is multiplied by 33,000 divided by 36,000. Are you getting it? Are you able to understand? Now multiplied by 80%. Okay. Why multiplied by 80%? Because 20% is cash sales. So we require only the credit sales. So multiply by 80%. What is the credit period allowed to customers? 2 months. So into 2 by 12. Okay. Cash and bank balance is given to us. Current liabilities, Sunday creditors, very, very important. Sunday creditors. What have they said at the beginning of the problem? What have they said? First statement, very important. First statement. What have they said? Well, first statement. CAT Limited, which is to commence on first April. That means it's a new business. What does this mean? It means it's a new business. So in the case of new business, what is going to happen? Opening stock will be nil. Opening stock is nil. Correct? So if opening stock is nil, what was one of my points? If opening stock is nil, raw material purchased is equal to raw material consumed plus closing stock of raw material. Point is clear? Raw material consumed plus closing stock of raw material. So, what is raw material consumed? Raw material consumed is what I'm showing here in the revenue statement. 3,12,000 is my raw material consumed. Okay. Raw material consumed 3,12,000 plus closing stock of raw materials. From where will I get this? This is from here. Closing stock of raw materials we calculated at the beginning, 26,000. So 3,12,000 raw material consumed plus closing stock of raw materials into 80% because 20% is cash purchase. 20% is cash purchase. So credit purchase will be 80% into 3 months credit into 3 months. That will be 67,600. Outstanding wages are given, outstanding goods are given. Calculate total current liabilities 1,04,430 minus and you get your balance of 1,23,237. 25% of that will be 30,800. I give you 2 minutes to go through the problem, see if you have understood the question and solution. All calculations important. I have included everything in this problem to see whether you have understood all the adjustments. Well, any questions you want to ask? You can ask me. It's a comprehensive problem where I've included all the possible adjustments. No questions? Shall we move ahead? Let us come to the next topic, receivables management. Concept of receivables management, it is your debtors plus your bills receivable. Cost of maintaining accounts receivable, I call it as ABCD and COCD. ABCD, administrative cost, D for bad debts, C for collection cost, and D for discounts. COCD, cost of carrying debtors or cost of financing. Okay. Aging schedule concept I have explained to you on your in your study material, your class material, on page 30. You can refer to that. Important item here is the concept of factoring. The factoring is a financial service. It's an arrangement between a firm and a financial institution, under which the firm receives advances against its receivables from the financial institution. Why this factoring? Because if I have a bill of exchange, where the customer has accepted to pay after 3 months, and I want immediate cash flow, what will I do? I will take that bill of exchange, go to the bank and discount the bill. So there is a possibility of me discounting the bill and converting it into cash before the period of 3 months. Okay. But if I have debtors in my balance sheet who have said that they are going to pay after 3 months, I've given them credit, 3 months credit is given to them. So they are going to pay me after 3 months. So that is going to be the case. Then what is my position? I'm stuck with the debtors for 3 months. So to solve that problem and to ensure that my funds don't get blocked in the form of accounts receivable, in the form of debtors, we have a financial service which is called as factoring, where a factor is a broker, like an agent. Okay, just like we have a commission agent, a broker, like that we have an agent called as a factor. This factor is going to ensure that. The accounts receivables get converted into cash. How? I will tell him that I'm going to sell all my debtors accounts to him. And whatever is the amount outstanding from the debtors, he will make immediate payment for that. Less, of course, his commission and his service charges, his interest. But I will get liquid cash before 3 months, which I can invest in the business, which I can use as my working capital. Okay, so factoring is an agency service which is provided by an agent called as a factor. The factor may be an individual or a group of individuals or a partnership firm or any other company or any other financial institutions or any other bank also. Okay, now classification of factoring can be done on 2 bases: on the basis of risk and on the basis of amount. On the basis of risk, who will bear the risk of bad debts? We can have recourse factoring and non-recourse factoring. In recourse factoring, the risk of bad debts will be borne by the company and not by the factor. Okay, that is why we say recourse. Recourse means you can come back. You can come back to the company and claim your bad debts. So if you have purchased my accounts receivable, customer has not made the bill. So the agent will come back to me and collect the amount of bad debts from me. So that is called as recourse factoring, where the risk of bad debts will be borne by the company, the entity. Non-recourse factoring, I tell the factor that now all the customers are your headache. You have to collect the amount, run after the customers, force the customers, threaten the customers, do whatever you want. But bad debts, if they are there, it is your loss. I'm not going to bear the loss. That is non-recourse factor. So on the basis of risk of bad debts, we can classify as recourse and non-recourse. On the basis of amount, either you can have full factoring where the entire amount of accounts receivable is going to be compensated by the factor. So if I have 4 lakhs of debtors, the factor takes over the entire 4 lakhs and pays me 4 lakh minus his commission and interest. Or he says that no, I will not take the entire amount of the practice. I will take only 50% of the practice, 50% of the debtors. So he takes only 2 lakhs of the debtors, minus his commission and minus his interest. The remaining 2 lakhs are still owed. So that will be a partial factor. The full factoring, entire amount of accounts receivable are taken out. Partial factoring, a part of the accounts receivable are taken out. Okay. That is about factoring. We will take our question on factoring. Then we have 2 items which are theory questions, but which are asked in the examination quite frequently on this one. One is concentration banking system, and the other is lockbox system. Details of that I'll go into on page 32. Concentration banking system, which I'm talking about, and a lockbox system. They are similar with a small difference. Let us say that I'm having my business in Bangalore, but my customers are there all over the country. And 1 or 2 customers are in the northeast, in the remote villages of Assam, in the remote villages of Mizoram. Okay. Now, normal method was that when they purchase goods from me, they send me a check. That check, when they send to me, it takes 10 days to reach me. Okay, it takes 10 days to reach me. After it reaches me, let us say it reaches on Saturday morning, and it is the second Saturday, bank holiday, right? So on second Saturday, I cannot deposit the check. Saturday goes, Sunday goes. Monday, I deposit the check. So 10 days the check was in transit. 2 days it was in my drawer. Monday, I deposit the check. It takes another 2 days for clearing, minimum. Sometimes it takes 3 days for clearing. So 10 plus 2 plus 3, 15 days are lost in this process. Now that is called as, one more important point for you, is that the word flow. Different types of flows are. This is again given in my theory. Last part. Different types of flow. Mail flow, processing flow, time flow. So all those things are given in my theory. So flow is what the time gap between my customer dispatching the check and I'm getting the credit. 15 days are lost. Okay. So first of all, I have given him 3 months credit. At the end of 3 months, he sends that check by post. I get that check within 10 days. I deposit it after 2 days. And another 3 days for clearing of the check. So that means after 3 months of credit also, my check gets postponed to 15 days. So I want to discourage that. I want to reduce the flow. Since I want to reduce the float, what will I tell my customer? If you don't mail the check, please. Whatever check you are preparing now, go to my nearest bank over there. I am doing business in ICICI Bank. So go to the nearest ICICI Bank in your area, wherever you are staying. Go to the nearest ICICI Bank. This is my account number. Deposit the check in my account number. So that ICICI Bank branch of Mizoram will get the check of the customer. They will find account number. They will say that account number is belonging to a Bangalore customer. They will credit it to my account there. So within maximum 1 or 2 days, I get the credit. Where 15 days were lost, I'm getting the credit within 1 or 2 days. So wherever my customer is, I tell my customers, please don't send the check by mail. What you can do is you can deposit the check in your nearest branch of my bank. And all those branches, the one customer may be in Delhi, one customer may be in Punjab, one customer may be in Gujarat. All those customers, they deposit my check in their respective branches of my ICICI Bank. All those branches then transfer the credit to my account here in Bangalore. What is that? concentrated banking. All my accounts are handled from bank. Right? So that is concentration banking system. So that means there is one collection center where all the checks will come and fall. Concentrated banking system. Lockbox system. Limitation of concentration banking is lockbox system. Customer in Mizoram tells me, sir, you are a hi-fi customer, you are a hi-fi manufacturer, you are having your bank account in ICICI. There is no ICICI bank in Mizoram. We are poor people here. We don't have bank for the next 30 kilometers. The closest bank is SBI. ICICI is not to be seen there. It's a private bank. Sir. SBI branches are, but that is 30 kilometers from my place. How will I do 30 kilometers to deposit your check over? What I tell you? Okay, fine. No problem. Bank is not there, not an issue. But post office will be there now. Our Indian postal telegraph system is there. PNT system. Government of India is there. In every village it is there. But tell him post office is there, he says yes. But tell him go to the post office, the nearest post office. Tell me what is the branch of the post office. And at that branch, I open an account. I open a lockbox. You know, in the papers, you get PO box number. The PO box number is nothing but post office box number. It is a lockbox number. So I open an account, I open a lockbox. And I tell him, please go and deposit in the lockbox. Don't worry about the bank. Then I try to find out in Mizoram where is my ICICI branch. Now that branch of mine is 50 kilometers away from this place. So I tell my branch of Mizoram. As soon as I get notification from customer that he has put the check in the lockbox, I tell my branch in Mizoram, ICICI branch, please go to so and so post office, collect the check from there and put it in my account. The customer need not do anything. Customer will go and put it in the post office box. My branch will go to that post office, open that box, remove the check from there, and give me credit. Maximum how many days? 2 days. 3 days. But 15 days time is 2 days. That particular system is called as lockbox system. Okay. So details on this I have given to you on page 31, page 33 of your capsule. Some important points. Basic objective of receivables management is to optimize the returns on investment on these assets. Maximize the returns. Optimize means maximize returns on investment on accounts receivable by increasing the credit period allowed to customers. By increasing the credit period allowed to customers, there may be increase in the sales volume. I may be able to sell more goods, but at the same time, the probability of bad debts, administration cost, and collection charges may also increase. So as we have more and more customers, it becomes difficult to control. It becomes difficult to check the customer's credit worthiness. So then, in that case, the possibility of bad debts will increase. Administration, that means maintaining books of accounts for the customers, updating the books of accounts, appointing people for that. So administration cost increases. Customers are not paying on time, so I send reminders to them. Customers don't make payment after that, I send legal notices to them. Court cases are there, legal expenses are incurred, solicitors expenses, court expenses. So all those costs will increase with the increase in sales. Right? On the other hand, if you reduce the credit period, the opposite, what will happen? I save on all these expenses. But because the credit period is reduced, my sales will come down. Because customers want credit. If I tell them, initially I have given 3 months of credit, I reduce it to 1 month. Customers will say, earlier you were allowing us 3 months to pay, now you are not allowing us even 2 months. So straight away coming down to 1 month. Within 1 month, I can't pay. So many of my customers may leave. The sales volume will fall. So Third point, in selecting the credit period, we should compare the net gain arising from each of the credit policies. Whether increasing the credit period will give me more profit or decreasing the credit will give me more profit. That I will have to decide by finding out the net gain, net loss. Whichever credit policy gives me a higher net gain, that means I will see the benefits of increasing the credit period, benefits of decreasing the credit period. Whichever gives me more profit, I will accept. Okay, so that is your summary of your accounts receivable problem. Problems are very simple on this. I don't think much explanation is there. What we can do is this 8 o'clock, we will take a 10 minutes break and continue after that because I will be taking the lecture up to 9:40. So 10 minutes break from now, 8:10 we come back again and we will continue up to 9:40. Will you start?
Yes, sir.
Yes, sir.
So give you a small example here. This is how to solve the problem. The firm sells 40,000 units of the product per annum at 35 per unit. Average cost per unit is 31. Variable cost is 28. Average correction period is 60 days. Bad debt losses are 3% of sales and correction charges 15,000. Firm is considering a proposal to follow a stricter correction policy which would reduce bad debt losses to 1% of sales and the average correction period to 45 days. So things to be highlighted here. First is that originally it was 60 days. You are now working for 45 days because you are working to bring it down to 45 days. It would, however, reduce the sales volume by 1,000 units. So from 40,000 units, it will come down to 39,000 units and increase the collection expenses to 25,000. The firm's required rate of return is 20%. Would you recommend the adoption of the new collection policy? Assume 360 days in a year for calculation purposes. Wherever they have given, there will be make use of 360 days. Otherwise, you will take 365 days. So, statement showing evaluation of credit policies. Present 60 days, proposed 45 days. Sales in units 40, reduces by 1,000. So, it will come down to 39,000. Sales in rupees, selling price is given. The selling price multiplied by the, that is 35 into 40. It will give 14 lakhs and 35 into 13 and will give you 13 lakhs 61. Less the variable cost, 28 rupees. So 28 into 40 and 28 into 39. Contribution to calculate. Less the fixed cost. Ensure that you are maintaining the same format here. Less the fixed cost, you will get gross profit. From the gross profit, your ABCD and the COCD will be deducted. Administration cost if any, bad debts if any, collection charges if any, discounts if any, and cost of carrying debts. So after calculating gross profit direct, administration cost, bad debts, collection cost, discount. Now you'll find that administration cost and discounts are not there in the form. Do I have to write? Yes, you have to write. Because in the statement of evaluation of credit policies, the format should not change. You get marks for the formats. So if you don't write administration cost, you don't write discount, you may be losing this. So these are small points that you have to take care of. Because credit evaluation policy format is that after gross profit you minus the cost of accounts receivable, which is ABCD. After doing that, so your bad debts were initially, within 3%. Yes. So initially your bad debts are 3%. Now it has gone down to 1%. Okay. So 3% of 14 lakhs you calculate 42,000. And 1% of 1 lakh, 13 lakh 65 now down to 13,650. Collection cost initially was 15,000. Now it has gone up to 25,000. So increase in collection cost. So 15,000 and 25,000. Minus that from your gross profit, you will get your net profit. I don't call it as net profit and leave it as this. 1,03,000 and 1,14,350. The fourth item is cost of carrying debts. Now for this, you have to give it over. Working note will be carrying marks. So what do? Is cost of carrying debts. Cost of carrying debts. So what I do, fixed cost plus variable cost. Okay. So that I will get from the question itself, from the solution itself. Your variable cost is here. Your fixed cost is here. So 1120 plus 120 is 1240. Then 10 lakh 92 plus 1 lakh 20. So 12 lakh 12,000. That's this. Accounts receivable, how to calculate now? Accounts receivable at cost. So whatever cost you have got here, multiplied by credit period upon 360. So here it is 12 lakh 40 into 60 days upon 360. You will get this figure of 2,06,666. Same way, cost over here is 12 lakh 12,000. 12 lakh 12,000 into 45 days upon 360, you will get 1,51,000. COCD is the cost of carrying debtors, which is your interest loss. This is 20%. Loss of interest, opportunity cost. Okay. So that is 20% of 2,06,667. That comes to 43,333. 20% of 1,51,500. That comes to 30,300. Okay. So this 41,333 and this 30,300 will be coming in the statement. And thereafter, you get your net gain of 61,667 and 84,050. So what has happened? By changing the credit period, by reducing the credit period from 60 days to 45 days, what has happened to your net gain? Your net gain has actually increased from 61,000 to 84,000. So is it advisable to adopt the new credit policy? Answer is yes. Because by adopting the new credit policy, your net gain is increasing to 84,050 from 61,667. That means there is a jump of nearly 22,300. Right? So that is how we present the answer for accounts receivable. So since the proposed policy results in a higher net gain, it is advisable to adopt the new policy. Now, one question on factoring are done. Again, I would prefer that you maintain the same format that I've shown over here, preferably. Firm has a total sales of 12 lakhs and its average collection period is 90 days. Past experience indicates that bad debt losses are 1.5% of sales. Expenditure incurred by the firm in administrative receivables collection efforts are 40,000. Factor is prepared to buy the firm's receivables by charging 2% commission. Factor will pay advance on receivables to the firm at an interest rate of 16% per annum after withholding 10% of sales. Calculate what is the most important thing. Effective cost of factor. Calculate effective cost of factor. I'll come back to that. If the company is expecting a returns on investment of 5%, so this is for your COCD. 5% is your opportunity cost for your COCD. Should the offer of the factor be accepted? Assume 360 days in a year. How to solve? First, I'll calculate what is the net amount receivable from the factor. Any factoring problem, the first step should be calculating the net amount receivable from the factor. How do you calculate that? Accounts receivable is given, which is given for a period of 90 days. So collection period is 90 days. What do? I take 12 lakhs multiplied by 90 into 360. So that gives me the accounts receivable. This I am selling to the factor. So the amount that is sold to the factor is the amount of accounts receivable, which is equal to 3 lakhs. Less is holding back 10% as reserve. So 10% of 3 lakhs held back as reserve, 30,000. Less commission of 2% that he is charged, which I have to pay. So he will deduct that 2% of 3 lakhs again. That is 0 2% of 3 lakhs again. That is 6,000. So 3 lakhs minus 30 minus 6 will give you 2,64,000. Now this is giving you 90 days in advance. You have to pay interest for that. So less interest at the rate of 16%. They have given that 16%. But for 90 days, so into 90 by 360, that amount of interest comes to 10,560. 264 minus 10,560. This much is the net amount receivable from the bank. This much amount should be receivable. It is receivable from the bank. Now I will do. This is the first calculation that has to be kept ready. After you do that, then you see what is the question. Calculate effective cost per factor. Right. Now, first, what I will do, I will calculate annual factoring cost. Okay. How to calculate annual factoring cost? Second part is I'm going to calculate annual cost, annual in-house cost. What is the meaning of annual factoring cost? What is the cost of employing the factor? Employing the agent. When I employ the agent, I have to pay him commission. You can see that I've paid commission over here. And I have to pay him interest. So two costs are there. One is the cost of commission, one is the cost of interest. Now 6,000 commission I have paid for 90 days. 6,000 commission I paid for 90 days. So for the year, how much it is? 6,000 into 360 by 90. You get 24,000. 10,560 I paid interest for 90 days. So for the entire year, 10,560 into 360 by 90. I'll get this. So total factoring cost By employing the factor, I have to pay this as additional cost. Okay. Suppose I did not employ the factor, then what would happen? If I did not employ the factor, then I would be incurring bad debt losses of 1.5%. That now I have transferred to factor. So if the factor is not there, I will incur bad debt loss of 1.5%. And there will be collection cost of 40,000. Collection cost of 40. 1.5% sales, bad debts. Okay. And collection cost will be 40,000. So bad debts 12 lakhs into 1.5%, 18,000. Administration cost 40,000. So total cost that I would incur if the factor is not employed, it's 58,000. Okay. Now see. The question was calculation of effective cost. Question was what? Calculation of effective cost of factor. They did not ask cost of factor. They asked for effective cost of factor. So now I say, what do you mean by effective cost of factor? It means by employing the factor. See, if I don't employ the factor, anyway, I'm going to pay 58,000. I'm going to incur a cost of 58,000. By employing the factor, how much more I'm paying? That is the effective cost of factor. Got my point? So effective word is there. Effective cost. It is not only cost of factor. Effective cost of factor. Then in that case, it means how much more cash outflow is there. I'm using the word cash outflow. How much more cash outflow is there if I employ the factor? So if I employ the factor, I am going to have an additional cash outflow of 8,240. 58,000 out of this is 66,420. Anyway, I'm incurring this cost of 50. Whether factor is there or not there, 58,000 is going to be. But if the factor is employed, how much additional cost I'm incurring? 8,240. So this is my effective cost of factor. Correct? And then I will calculate the percentage. What percentage? The effective cost of factoring percentage. Additional cost that I'm going to incur. Additional cost that I'm going to incur. 8,240 divided by 2,53,440. Where did I get this 2,53,440? See here. Here it is. So that is why this calculation becomes important at the root. So 8,240 divided by what I was supposed to get. This is the additional cost. Additional cost for getting this amount of 2,53,440 in advance is 3.25%. So 58,000 I was already incurring. By employing the factor, I am incurring additional cost of 3.25%. But what is the benefit? I am getting this amount of 2,53,440 90 days in advance. That is the benefit. And if I get that 90 days in advance, I can invest that. At 5% and get returns. So 3.25% is my cost. Okay, 5% is my returns. So do I make any benefit? Answer is yes. I have some benefit. 5% minus 3.5%. That is the benefit. That is 1.75%. Is my benefit. So my returns are higher than my cost. My returns are higher than the cost. Therefore, even if I incur additional cost of 3.25%, not an issue, because I will get a profit of 1.75%. If I invest that amount, I will get a profit of 1.7. Any difficulty with this now? Because I want to explain one more point. Everybody is understood? Yes or no? You can say something. Have you understood?
Yes, sir.
What I want to explain now is that if the word effective was not there, and I was calculating cost of factoring, will there be any change in the problem? Yes, there will be a change in the solution. Because word effective is not there. They have asked me only cost of factoring. the same question is asked, whether I should accept the service of the factor. So, what will be the difference in the solver? This part will remain same. Okay, this part is going to remain same. This part is going to remain same. Sorry, this part is going to remain same. Annual factoring cost. What is going to change is my annual in-house cost is going to change. This is going to change. If I'm comparing the factoring cost with the annual in-house cost, and the word is cost of factoring, the word effective is not. If cost of factoring is to be calculated, and decision has to be taken. Okay, what will be my annual in-house cost? All other expenses will be, all other items will remain the same. Now, in the annual in-house cost, I will have bad debts, same 18,000. I will have admin cost, same 40,000. And then I will have COCD. Then I will have COCD. What is COCD? What is COCD? Cost of carrying debtors, opportunity cost. How do I calculate that? Cost multiplied by the accounts receivable. But now cost is not given to me in the problem. Its cost, variable cost is not there. No problem. I take the selling price. On the basis of selling price, what is my accounts receivable? 3 lakhs. Correct? 3 lakhs are invested. 3 lakhs are blocked. What is my rate of return on investment? Had I invested that 3 lakhs in there, what would I have got? 5% interest. So COCD at the rate of 5% on 3 lakhs will be 15,000. Correct? No? So this will come to 73,000. Now I compare annual factoring cost of 66,240. 66,240. I compare with this 73,000. Which is less? Which is less? Annual factoring cost is less. In-house cost is more. So my decision remains the same. Since the annual factoring cost is less than the annual in-house cost, factor should be above. Factor should be above. So why that difference is there? That in this case, I am not considering the COCD here. It is not to be considered here. But it will be considered here. Because here I am comparing what? Cash with cash. Cash outflow with cash outflow. So annual factoring cost, because effective factoring cost. When I'm talking about effective factoring cost, I cannot take non-cash item and compare with cash. Okay. So effective factoring cost, I will take only cash items in the annual factoring cost and cash items in the annual in-house cost. But if I'm comparing annual factoring cost with annual in-house cost, I'm not using the word effective. Then this will be the calculation. So this part, annual in-house cost will be calculated with this part. You can take a note of this on the side. If the cost of factoring is to be calculated, not effective cost. The word effective is not. If the word effective is there, then this calculation. If the word effective is not there, then this calculation. Any problem? Understood. Any difficulty? All calculations are understood? Yes, Shreya?
Yes, sir.
Yes, sir.
So you can move ahead. Next topic is ratio analysis. Ratio analysis, what I have done is, I've put all the balance sheet ratios together, all the revenue statement ratios together, all combined ratios together. And then I have got a set of miscellaneous ratios. I would prefer to study this, as I told you earlier also when I was doing financial management, that I never expect my students to look up the formula. It's simply where you understand the ratio and remember the ratio rather than mugging up the formulas. And at the time of examination, sometimes because of the examination tension, you forget some formulas. So, balance sheet ratios, there are 6 balance sheet ratios. Why I call them as balance sheet ratios? Because both the numerator and denominator are taken from the balance sheet. The revenue statement ratios, I call them as revenue statement ratios because numerator and denominator are both taken from the revenue statement. Combined statement ratios, I call them as combined ratios because one of the numerator or denominator comes from the revenue statement, other comes from the balance sheet. Okay, then we have got some miscellaneous ratios. So, current ratio, quick ratio, stock to working capital ratio. Now I'm grouping the ratios in another way. Current ratio, quick ratio, and stock to working capital ratio. These are going to indicate short-term liquidity of the company. Okay, so whether the company is in a position to meet its short-term obligations, if I want to, I will take the current ratio, which is current assets to current liabilities, also called as working capital ratio. Current ratio is also called as working capital ratio. So it is current assets upon current liabilities. Quick ratio, also called as liquid ratio, also called as asset test ratio. It is quick asset upon quick liability, where quick asset is equal to current asset minus current liability minus, sorry, quick asset is equal to current asset minus stock minus prepaid expenses. Quick liabilities, in most of the cases, it is same as current liability. Or sometimes quick liabilities also can be calculated as current liabilities minus bank overdraft. Okay, minus bank overdraft minus income received in advance. But normally these items don't appear in the balance sheet. So if they don't appear in the balance sheet, your quick liabilities will be the same as current liabilities. So if you don't have a bank overdraft, why I'm saying don't have a bank overdraft, because normally we have a bank balance or positive bank balance. So that will come in the current asset. Income received in advance is a very rare item. Normally it is not. So in most of the cases, quick liabilities will be equal to current liabilities. In case you find that these items are minus, you get quick liabilities. Standard liquid ratio is 1:1. Standard current ratio is 2:1. Higher the ratio, the better. For certain ratios, higher the ratio, the better it is. Higher the better. Higher the better. Proprietary ratio, I'll come back to that later. Stock to working capital. Stock to working capital, lower the better. What does stock to working capital indicate? The amount of investment in stock of your out of your working capital. How much of your assets, how much of your working capital is invested in the form of inventory. And if you have a large stock as compared to the working capital, that means if your ratio is very high. Very high means what? More than one. Very high means more than one. Normally it should not be equal to one also. It should be less than one. So if your stock to working capital ratio is greater than one, then there is some serious problem. Why? Because there may be some overinvestment in stock. Overinvestment in stock or a large amount of stock piling up in the company, which may be on account of inefficient policy of the management or inability of the management in selling the goods, or that you are having slow moving obsolete items in the stock which cannot be sold. If your stock is made up of obsolete items, outdated items, you can't sell it in the market. Okay. So as a result of that, your stock is piling up and your stock to working capital ratio is more. So a high current ratio. Why I'm taking these two ratios? Because I want to show the link. A high current ratio with a high stock turnover ratio or stock working capital ratio. High current ratio with a high stock to working capital ratio is not good for them. It's not good for them. But a high current ratio with a low stock to working capital ratio is excellent for them. Because in that case, your current assets are made up of less amount of stock and more amount of other liquid assets. Okay, so that is what short-term surplus. Proprietary ratio, capital carrying ratio, and debt equity ratio. Proprietary ratio, how much of the total assets are financed by the proprietors. So proprietors finance upon total assets in total. Out of the total assets, how much are financed by the owners? So if you have a large amount of funds financed by the owners, then it is not advisable. Okay, if a large amount of funds are financed by the owners, it is not advisable. So you should have less amount of funds which are financed by the owners, more amount of funds which are financed by outsiders. So borrowed funds more are better than before. Okay. Now, capital gearing ratio, how to remove? Capital gearing ratio, it is capital bearing fixed rate of interest or dividend upon capital not bearing fixed rate of interest or dividend. I would write this as, I would remember this as well. I would remember this as borrowed funds plus preferential capital upon equity share capital plus the reserves. Okay, so remember this formula in this manner. It is borrowed funds plus preferential capital. Both of them are having, borrowed funds are having fixed rate of interest, preferential capital is having fixed rate of dividend. Equity share capital does not have fixed rate of interest or dividend. Reserves and surplus does not have fixed rate of interest or dividend. So BF plus PSC upon equity share capital plus reserves. This can be, you can have a high gearing ratio. High gearing ratio means more of debt finance, leverage value. Debt equity ratio, long-term debts to shareholders funds. Ideal ratio 2:1. That means your debt can be twice your equity. That is the optimal ratio. Okay. Now that is all about your balance sheet ratios. Revenue statement ratios are made up of two types of ratios. Revenue statement ratios can measure two things. One, it can measure profitability, and second, it can measure efficiency. So whether they ask you profitability ratios or efficiency ratios, it is your revenue statement ratios. In most of the cases, your revenue statement ratios are calculated as a percentage of sales. Most of the cases. The first five ratios which are there, how to remember? That total in the revenue statement ratios you are having about 10 ratios. How to remember those 10 ratios? First five ratios are profit ratios and expense ratios. In the format of your revenue statement, you got three profits that come: gross profit, operating profit, and net profit. The three main profits are gross profit, operating profit, net profit. So we have gross profit ratio, operating profit ratio, net profit ratio. Net profit ratio is further split up into two parts: net profit before tax ratio and net profit after tax ratio. Gross profit ratio, gross profit upon sales into 100. Operating profit ratio, operating profit upon net sales into 100. Net profit ratio, net profit before tax upon net sales into 100, and net profit after tax upon net sales into 100. So these are three profitability ratios. Then I have two expense ratios. One is operating ratio and the other is expense ratio, or operating ratio is also called as operating cost ratio, and this is also called as operating expense ratio. What is the difference here? Operating cost, I'm going to operating cost is equal to cost of goods sold plus operating expenses. Here, what is the expense equal to? The expense is equal to operating expense, which is made up of administrative plus selling plus finance. Okay. So when I say expense ratio, it is a ratio of operating expenses, that is the total of administrative plus selling plus finance upon net sales included. Okay. So 3 profitability ratios, 2 expense ratios in the order of your revenue statement. Gross profit ratio, operating profit ratio, net profit ratio. Then 2 expenses which are there in between. One is operating cost and one is operating expense. Operating cost, cost of goods sold plus all the operating expenses. Operating expense ratio, operating expenses A plus Y plus F, admin plus selling plus finance divided by net sales included. Okay. So these 5 ratios. Then we come to the remaining 5 ratios. Remaining 5 ratios are not calculated as a percentage of sales. Remaining 5 profits are not calculated as a percentage of sales. So what are the use of the remaining 5 ratios? Remaining 5 ratios have got, each one has got a different usage or different purpose. Okay. What is the different purpose? Stock turnover ratio, most important ratio. Okay. Stock turnover ratio is the most important ratio. Now, why it is important? First of all, turnover ratios are activity ratios. Turnover ratios all put together, we can have what is called as activity ratios. They in fact show the efficiency of operations. If your turnover ratios are high, it means that company is profitable, company is efficient, company is vibrant. So you have stock turnover ratio, you have fixed asset turnover ratio, you have working capital turnover ratio, you have capital employed turnover ratio. So any turnover ratio together when you take it, we call it as activity ratios. Turnover ratios in most of the formulas, numerator is sales. In most of the formulas, numerator is sales. And the denominator is the component that we are calculating. For example, fixed asset turnover ratio, sales upon fixed asset. Capital employed turnover ratio, sales upon capital employed. So sales always remains in the numerator. That particular component comes in the denominator, with the exception of stock turnover. With the exception of stock turnover ratio. Stock turnover ratio is cost of goods sold upon average stock. Now, why cost of goods sold and not the sales? Stock is always valued at cost. Stock is always valued at cost, not at selling price. Right? So, when we are calculating stock turnover ratio, we will take the cost of goods sold upon average stock, where average stock is opening plus closing divided. Now, in case cost of goods sold is not given, or cost of goods sold cannot be calculated, then I can calculate this also as sales upon average stock. Where cost of goods sold is not given or it is not available, I can calculate the formula with the help of sales also. So sales upon average stock. Okay. Dividend payout ratio. How much of the profit is paid as dividend? Which profit? Profit available for equity shareholder. So profit available for equity shareholder is what? NPAT minus preference. Profit available for equity shareholder is NPAT minus preference. How much of dividend you have paid? Equity dividend. So equity dividend divided by profit available for equity shareholders into 100 dividend payout ratio. Okay. Interest coverage ratio. Interest coverage. What I tell the students, what is the profit now in your revenue statement? What do you do? Sales minus variable cost contribution. What is the format? Sales minus variable cost contribution. contribution to minus fixed cost, we have got EBIT. EBIT minus interest, we've got EBT. EBT minus tax, we've got NPAT. NPAT minus preference dividend, we've got net income available for equity. Remember this format. You don't have to remember the ratios. No. Interest coverage ratio. Where is interest? Interest is here. This is your interest. Out of what it is paid out of EBIT. That means what is covering your interest? EBIT is covering your interest. When you say that you are covering, let us say that you are covering yourself with a blanket. What do? Blanket comes over you, or you go over the blanket. When you are covering yourself with a blanket, you put the blanket on you, over you, or you put the blanket first and then you sleep on top of the blanket. Put the blanket over you. Cover means what? You are covering yourself with a blanket. Blanket is over you. EBIT is covering interest. So EBIT will be over what? Numerator. EBIT is in the numerator. What is being covered is below. Interest is being covered. So interest will be below. So EBIT upon interest. Okay. Next is debt service coverage ratio. What is this used for? Whether company has repaying capacity of the principal and interest. Installment. To check that, we calculate debt service coverage ratio. Principal is paid out of net profit after tax. Cash. Net profit after tax in cash. So in cash means what? All non-cash items are to add. So NPAT plus depreciation plus amortization. Non-cash item. I have to add that because I want the net profit after tax cash. Or you can say cash net profit after tax. So NPAT plus depreciation plus amortization is out of which I pay the principal. But interest is paid out of EBIT before the interest. So before the interest means add interest. Before the interest. So before the interest, what is that? Before the interest, this is. So add back the interest. So NPAT plus depreciation plus amortization plus interest divided by the installment, which is made up of principal plus interest. Okay. Then we have price earning ratio, market price per share, NPS upon EPS. The combined ratios, first three combined ratios, returns on capital employed, returns on proprietors funds, returns on equity shareholders funds. Again, I come back to the revenue statement. Returns on capital employed. Returns on proprietors funds is in order. And returns on equity shareholders funds is So what is returns on capital employed? EBIT upon capital employed into it. Once you know the revenue statement format, you know it. What is returns on proprietors funds? NPAT upon proprietors funds into it. What is returns on equity shareholders funds? Net income available for equity shareholders, which is NPAT minus preference dividend. Net income is what? NPAT minus preference dividend. Upon equity shareholders funds, that is equity share capital plus interest. Then we have debtors collection period and debtors turnover ratio. Debtors turnover ratio, debtors collection period, net average debtors plus average bills receivable. Net average debtors. Now here, one important. If opening balance sheet is given, always calculate average capital employed, average proprietors funds, average equity shareholders funds. Make this addition in your notes. This average capital employed, average proprietors funds, average shareholders funds. Wherever opening balances are given, you have to take the average. opening plus closing divided by average capital employed. Opening capital employed plus closing capital employed divided by. So normally it is all average calculations. Debtors collection period, net average debtors plus average bills receivable upon net credit sales. You have to understand this, net credit sales. So always it is the credit sales that we are considering when we are calculating debtors. Into number of days in a year or number of months in a year or number of weeks in a year, depending upon how the data is given. ETR is equal to reciprocal of this, net credit sales in the numerator upon average amounts receivable in the denominator. So debtors collection period and ETR are reciprocals of each other. But when you are calculating the collection period, you can multiply by number of days or number of months or number of weeks. Whereas in DTR, it is reciprocal without any multiplication. Same is the case with creditors payment period. Net average creditors plus average bills payable upon net credit purchase into number of days in a year. Creditors turnover ratio is reciprocal of it. Okay. So what can be done is that I can write debtors collection period is equal to 365 divided by DTR. Okay. And the creditors payment period, this collection period of creditors, I can write it as 365 divided by creditors payment ratio. Okay. So depending upon which particular what data is given to me the problem, I can utilize the different problems. Fixed asset turnover ratio. I would prefer to take this as sales upon fixed assets. Here again, if you are having the average assets, then average fixed assets. Okay, then capital turnover ratio, sales upon capital input. Current asset turnover ratio, sales upon current asset. Returns on investment, returns or profit divided by investment into it. Returns on assets and PAT upon average total assets into it. Then miscellaneous ratios, EPS ratio, net income available for equity shareholders and PAT minus preference dividend divided by number of equity shares. Dividend per share ratio, total equity dividend paid divided by number of equity shares. Dividend yield ratio, whenever there is a yield ratio, always remember denominator is MPS. Whenever there is a yield ratio, denominator is MPS. So if it is a dividend yield ratio, EPS upon MPS. If it is a earnings yield ratio, EPS upon MPS. Okay. Then you have absolute cash ratio, that is cash plus bank plus short-term securities upon current liabilities. Interval measure, these are for immediate solvency. This is for operational solvency. Cash plus bank plus short-term securities plus bills receivable upon average daily cash operating expenses. Okay. Then I'll give you problems on this. Now, problems on reverse ratio. What is reverse ratio? Given the ratios, preparing the balance sheet. Given the ratios, preparing the financial statements. These types of questions are important for you because these are more frequently asked. December 2021, last year exam paper. This type of question carried about 10 marks in the examination. Ratios are given, you just have to calculate the figures and put it in the balance sheet. Just go through this type of question. Returns on capital employed using viewpoint. Viewpoint model. What is the viewpoint model? Have you studied this viewpoint model? Have you done this in class? You guys answer here. You don't have the energy to answer also. Have you done viewpoint model in the class? Yes, Ashwin. Not done. Viewpoint model. It can be asked a short question on this theory question. What is the viewpoint model all made up of? It is actually an important component of ratios, but nowadays I don't know why they have stopped asking, not stopped rather. They have not been asking any questions of viewpoint, but it is there as a part of the syllabus. a US-based company wanted to find out what is the core reason, what is the main reason for a change in the ratio. They wanted to get down to the root cause of the problem or root cause of the success. For example, I've taken one ratio, returns on capital employed. Returns on capital employed. Formula is EBIT upon capital. Now suppose that returns on capital employed of the first year and the second year change. Either it increases or it decreases. I'm concerned more with the decrease. Okay. So if there is a decrease in the returns on capital employed, which is a cost of concern, I want to analyze why there is a decrease in this cost of returns on cost of capital. So I do the breakup of this. I do the analysis of this. So I say that returns on capital employed, EBIT upon capital, I'll split it up into two parts. Okay. One will be EBIT upon sales. So I separate the numerator here, divided by sales. I separate the denominator and multiply by sales. So sales and sales will cancel. I get my original formula EBIT upon capital. Now, this left hand side EBIT upon sales is nothing but profit upon sales. So profit upon sales is my net profit margin ratio. Multiplied sales upon capital employed just now here. This capital turnover ratio. Okay. For net profit margin ratio, how do we get net profit or how do we get operating item? This income minus the expenses. Income minus the expenses. What are the incomes here? Sales is there. Other income is there. What are the expenses? Operating expenses and other non-operating expenses. So from the sales and other income, when I minus these two items, I'll get the net profit. So why did the ratio decrease? I want to know. Why did the ratio decrease? So ratio may have decreased because income is less. Sales has reduced. So sales has reduced. My net profit margin will reduce. If my net profit margin reduces, my ROC reduces. Okay. If my expenses increase, so I'm talking about reduction in ROC. So when will the reduction come? When the sales decreases or when the expense increases. So if the expense increases, my net profit margin will decrease. If my sales decreases, my net profit margin decreases. So which of the two are my reason for decrease in ROC? So if I'm going to do analysis, I will find out what was the sales of the last year, what is the sales of the current year. Has there been a decrease in sales? Answer is yes. I'll say that ROC has decreased because of decrease in sales. Suppose sales has not decreased, sales has actually increased, but my operating expenses also have increased, but more than proportional. As a result, my profit margin is low. So I will say that reason for decrease in the ROC is because of increase in the operating expenses. Okay. Let us come to capital turnover ratio. Capital turnover ratio, sales, so we have already discussed it. So if the sales are going to decrease, numerator decreases, ratio will decrease. Okay. Now, what is going to happen here? What is going to happen? So capital I'm going to exclude. I'm going to expand. Capital is what? Capital employed. It is a fixed assets plus working capital. This is a capital. So if there is a increase in the fixed assets, if there is an increase in the fixed asset, there is an increase in capital employed. That increase in capital employed will increase the base of your ratio. If the ratio base denominator increases, ratio decreases. So the fixed assets increase. If the working capital increases, then my ROC decreases. Working capital. Working capital is made up of current assets plus current assets. If current asset increases, my working capital will increase. And if my working capital increases, my capital employed increases. If my capital employed increases, my ROC will decrease. If current liability decreases, my working capital will increase. So if working capital increases, my capital employed increases, denominator increases, ratio decreases, ROC decreases. So these are the various causes of decrease in the returns on capital. So what is the root cause? If I want to find out, I will get that by analyzing, by breaking up the formula into its simpler components, into its basic components, and then getting the final, the main cause or the main root cause of the increase or decrease in the. So like this we can do with returns of capital employed, returns of proprietors funds. Okay, so we can do this with number of ratios. We can analyze those ratios, break down those ratios, and find out what is the root cause of the increase or decrease in the ratios. Okay. Then we come to leverage. What is leverage? I will explain the concept of leverage. Leverage exists when a small change in an independent variable brings about a more than proportional change in the dependent variable. The general definition of leverage is that when a small change in any item brings about a more than proportionate change in the dependent item, then we have leverage. Operating leverage implies the use of fixed operating cost. Operating leverage implies the use of fixed operating costs in the operation of a firm. Operating leverage is the ability of the firm to use the fixed operating cost to magnify the effects of changes in sales on its input. So again, the format is the same: sales minus variable cost contribution minus the fixed cost to get minus the interest. So operating leverage is concerned with this part. So a small change in sales or a small change in contribution, if it brings about a more than proportionate change in the EBIT, then I say that there is operating leverage. And that operating leverage will come because of the fixed cost, which you can see that it is in between contribution and EBIT. There is a fixed cost. Okay, fixed operating cost. What is financial leverage? So this part is your operating leverage. What is financial leverage? Ability of the firm to use fixed financial charges to magnify the effect of changes in EBIT of the firm's EPS. Financial leverage occurs when the firm uses fixed interest or dividend-bearing securities like debentures or preferential. Okay, so that is when this happens. So it is your EBIT, the small change in EBIT. If it brings about a more than proportionate change in EBIT, then we are having financial leverage. Okay, when you combine operating leverage with financial leverage, you will have the combined leverage. So all the formulas are there. Operating leverage, static formula, contribution upon EBIT. Percentage formula, percentage change in EBIT upon percentage change in contribution of sales. What you can see is that here contribution, if it is static formula, contribution comes in the numerator and EBIT comes in the denominator. Here it is reversed. So EBIT comes in the numerator and contribution comes in the numerator. When the percentage is taken, it is reverse of the static formula in the percentage. Financial leverage, EBIT upon EBIT. Financial leverage in percentage form, percentage change in EBIT upon or EPS upon percentage change in EBIT. Now there is one more formula for financial leverage. That is if your balance sheet is having preference dividend, then the formula will be EBIT upon EBIT minus preference dividend divided by 1 minus 2. You can please note down this formula. It is EBIT upon EBIT minus preference dividend upon 1 minus 2, where preference capital is also there in the balance sheet. Don't forget to take the preference dividend divided by 1 minus 2 in the denominator. Okay. Combined leverage, you are having contribution upon EBT, percentage change in EBT or EPS upon percentage change in contribution. So there you have operating leverage and break-even point relationship. If business operates at break-even point, EBIT is equal to 0. If business operates above the break-even point, there will be a profit. Profit means that EBIT is positive. And if EBIT is positive, the operating leverage will also be positive. Business operates below the break-even point, there will be a loss. Loss means negative profit. EBIT will be negative. At this point, operating leverage will also be negative. Then financial leverage and break-even. Now, financial leverage, when EBIT is equal to fixed interest charges, there is no profit or loss to the shareholders. EBIT is equal to 0. This is called financial break-even. So, in one of your examination papers, if you see the past years, you had the question for 2 marks. What was the question? Define financial break-even. Define financial break-even. 2 marks question. What the students wrote? Financial break-even point is that point where total cost is equal to total sales. And they got 0 for it. Because that is not the financial break-even point, that is the operating break-even. And they had asked in the examination financial break-even. So financial break-even point is that point where your EBIT is exactly equal to your interest amount. So when you deduct the interest from the EBIT, you get a 0. So that is called as a financial break-even. That means where your EBIT is exactly equal to your amount of fixed interest charges. Okay. Then we have taken a question from the RTP of 2019. Company had the following balance sheet as on 31st March 2019. All figures are in quotes. Equity share capital 100 crores, 10 crore shares of 10 rupees each. Reserves and surplus 15% range is current liabilities. Asset side we have got net fixed assets and current assets. Additional information given is as follows: fixed cost per annum excluding interest. Excluding interest is given to as 80 crores. Variable operating cost ratio is 65%. Variable operating cost is 65% means what? It means that your PV ratio is equal to 35%. Or you can call it as contribution margin ratio. Okay, so variable cost is 65%, that means sales is 100, variable cost is 65, your contribution is 35%. Total asset turnover ratio, sales upon total assets, that is equal to 2.5. And income tax rate is 40. You are asked to calculate earning per share, operating leverage, financial leverage, and combined. So first we take the total assets which are given to us as 400 crores. Total assets in the balance sheet, 400 crores. Okay, asset turnover ratio is given to us as 2.5. So total sales is equal to asset turnover ratio means what? Sales upon total assets. So sales is equal to 2.5 into total assets. So 2.5 into 400 crores, it comes to 1,000 crores. So I first prepare the revenue statement for this. Sales is 1,000 crores. Variable operating cost is 65% given to us in the profit. So 650. Contribution is 350. Fixed cost other than interest given to us in the profit, 80 crores. Okay. So EBIT is 270. Less the interest on debentures. You'll have to go to the balance sheet. Debentures are 200 crores. 15% of 200 crores is 30 crores. That will come here. EBIT is 240. Okay. Now, earning per share, less the tax 40%. Your earnings available for equity shareholders is 140. Earnings per share is 144 crores divided by 10 crore equity shares. So that comes to 14.4. Operating leverage contribution upon EBIT. Contribution is 350, EBIT is 270. So 350 by 270, it comes to 1.296 times. Operating leverage indicates sensitivity of earnings before interest and tax to change in sales at a particular level. Financial leverage, EBIT upon EBT. EBIT is calculated as 270, EBT is 240. So 270 upon 240, 1.125 times. Financial leverage is very comfortable since the debt service obligation is comparatively small. Okay. Combined leverage, operating leverage into financial leverage, 1.296 into 1.125. Okay. So in this way, we calculate all the leverages. Up till here it is fine. Okay. Now what we'll do is we'll take a question. We'll take a question which we have. I promised you something last time, which we have not done. What did I promise? Anyone remembers? I promised to do something during the revision time. This last time, do you remember what I promised? Yes, Sushika. Do you recollect anything? Last lecture I promised something. I'll do it during the revision time. If everybody is forgotten, then I can conveniently avoid it. Yes, Shreya, do you remember? Yes or no?
Yes, sir.
What do you remember? Tell me. What did I promise?
So you told there's one concept that you'll explain in the revision.
Yeah. Which is the concept? I can get away with it. I'll tell you that I've explained all the concepts. Yes, Avi. All of you were there in the last lecture. That is what I'm asking. Do you recollect? People will fully recollect. I told you that I will explain the concept of modified internal rate of return. Or you say yes. All this time I was asking you did not remember. Capital budgeting, we had done all methods and modified internal rate of return was not. Why I have kept it for the last? Because you have to remember this from the exam point. Because up till now we were not asking questions based on MIR. But now they have started asking questions based on MIR. Two limitations of IRR method that I taught you was that one, IRR is something which is unpredictable and we can have multiple IRRs. Okay, we have discussed this. We can have multiple IRRs. Secondly, the IRR that we are calculating will not give us the same answer as the NPV method. That is because of the reinvestment rate that is included in the IRR. So to remove that problem of reinvestment rate and to remove that problem of multiple IRR, Modi has come out with modified internal rate of return. Okay. Modi has not come out with this. Actually, it was developed long back. It is called modified internal rate of return. Now, in modified internal rate of return, I do not calculate the present values. I repeat again, in modified internal rate of return, I do not calculate the present values. Alternatively, I calculate the future values of the cash flows. Okay. So MIRR is the compounding rate of interest. IRR is the discounting rate of interest. MIRR is the compounding rate of interest. Okay. So what you need to highlight here, it's on page 26, I think. What you need to highlight here is that MIRR is the rate of compounding. Okay. So how do I calculate that? I calculate that as cash outflow into 1 plus R raised to n equals to total terminal value. Terminal value is nothing but future value. Total future value or terminal value of all cash inflows. Okay. So I have taken an example here, which we are going to solve just now. Okay. You are using a financial analyst. You are a financial analyst, right? You are a financial analyst of A Limited. Director has asked to analyze two proposed capital investments, Project X and Project Y. Each project has got a cost of 10,000 rupees and the cost of capital is 12%. The project's expected net cash flows are given to you. So this will be the first one that is given to you. It is the cost of the project. Okay, cost of the project. So year 0 means always cost of the project. It's outflow of cash. And then from year 1 to year 4, you are having all the cash inflows given to you. What they have said is using MIR, state whether the project is viable or not. I assume that you are having the PDF of this. So I will start with my calculation on the PowerPoint. Check this. I'll have to record the PowerPoint to this. Can you see the PowerPoint? Okay. Now, how to solve the problem? Calculation of MIR. Right, calculation of MIR. Below that, first to calculate. First to calculate. Terminal value. Bracket with PV of all cash inflows. Terminal value of all cash inflows. Starting with project X. My first cash flow for the first year is 6,500. Understand what you mean. 6,500 is the first year's cash flow at the end of first year. This will be invested. Total how many years are there? 4 years are. This 6,500 is going to be invested for 3 years. Because I received this at the end of first year. So it will remain invested for second year, third year, fourth year. 3 years. So 6,500 into 1 plus K, K is 12%. 1.12 raised to 3 years. Plus, second amount is 3,000. Received at the end of second year. So it remains invested for third year and fourth year, for 2 years. So it is into 1.12 raised to 2. Third cash flow is again 3,000. Received at the end of third year, so it will remain invested for 1 year. So 1.12 raised to 1. Fourth year's cash flow is 1,000. 1.12 raised to 0. Raised to 0. Now evaluate this. 6,500. 1.12 in factor form up to 4 decimals. 1.12. 1.4049. This step. Okay. Plus 3,000. 1.12 will give us 1.2544 plus 3000 into 1.12 3360 plus 1000 into 1.12 raised to 0 is 1. So into 1000. Now calculate. 6500 into 1.4049 is 9131.85. So I'll take it as 9132 plus 3000 into 1.2544 is 3763 plus 4360. $17,255. Same way we'll do for project Y also. First year it was 3,500 into 1.12 raised to 3 plus 3,500 into 1.12 raised to 2 plus 3,000 into 1.12 plus 3,000. Sorry, 3,500 plus 3,500. So you can directly calculate that. 3,500 into first one is 1.4049. It's 4917. 3,500 into 1.2544. 4397. 3,500 into 1.1. 390. Plus 3,500. Just check the calculations. $16,727. What is the formula for MIRR? MIRR is equal to cash outflow into 1 plus R raised to n is equal to terminal value of cash inflows project X. Cash outflow is the cost of the asset. $10,000 into 1 plus R raised to n. N is 4. 1 plus R is to 4 is equal to 17,255. 17,255 Therefore, 1 plus R raised to 4. Divide 17,255 by 10,000. So 1 plus R raised to 4 is equal to 1.7255. Now 1 plus R raised to 4 is what? 1 plus R raised to 4 is 1 plus R raised to 2 plus 1 plus R raised to 2. Correct? If I remove the square root of this, what will happen? 1 plus R raised to 2 will remain. Again, if I remove the square root of this, then what will remain? 1 plus R will remain. So I say here, taking square root twice. Taking square root twice. On both sides. On both sides. What will happen? On the left hand side, I will get 1 plus R is equal to 1.7255 square root double time. 1.7255. Take the square root 2 times. What will you get? 1.1461. Take the square root 2 times. 1.1461. So R is equal to 1.1461 minus 1. So R is equal to 0.1461 or R is equal to 14.61%. Therefore, MIRR is equal to 14.61%. Okay. Same way I will do for project Y also. Cash outflow is 10,000 into 1 plus R raised to 4 is equal to 16,727. 16,727. Therefore, 1 plus R raised to 4 is equal to 16,727 by 10,000. So 1 plus R raised to 4 is equal to 1.6737. Taking square root twice. On both sides. One plus R raised to 4. So 1 plus R is equal to 1.6727 1.1372 correct now? So R is equal to 0.137. Now here, like your IRR method is same. If MIRR is greater than cost of capital, you can accept the project. Okay, MIRR should be greater than cost of capital. What is your cost of capital here? cost of capital is 12%. So in both the cases, you find that cost of capital for project X is 14.6, it is more than 12%. Project Y also it is 13.72, more than 12%. But you can accept both the projects. But which project will you accept? You will accept project X because that MIRR is comparatively higher than the MIRR of project Y. Okay, so write down the answer, write conclusion. Both projects can be accepted. Both projects can be accepted. Since their MIRR is greater than cost of capital. Bracketed it, 12%. But project X has a higher MIRR. Therefore, it is recommended to select project X. Okay. So for MIRR, you have to first calculate terminal value or future value. Terminal value is future value. Future value of all the cash inflows. Okay. And then equate the future value of all the cash inflows to the cash outflow multiplied by 1 plus R raised to n. R value is your MIRR. Now, in this problem, I've kept it simple, where you can easily calculate square root twice and get the answer. But suppose it was 1 plus R raised to 5, then you cannot calculate the square root. So then in that case, we have to go like IRR, where trial and error method will be applicable. Where you go on substituting the value of R. First we start with 10%, 12%, 15%. Then we'll see which of the two it lies between. Then do interpolation. Interpolation, like we have done in IRR, and solve it. Okay. So I completed my promise also that I will be doing MIRR at the time of revision. I've done that to solve the problem. Right. So tomorrow we'll meet at the same time, 6:30. 6:30 to 9:40. We'll continue with the revision of FF. Okay. So till then, good night. Have a nice day tomorrow. Tomorrow evening, 6:30.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you.
Thank you, sir.
Sir.